questions about US debt levels have been asked since well before the US elections, but they've really ramped up since the one big beautiful bill was signed by US President Donald Trump. Joining me today to unpack the implications of US fiscal policy is Head of Research, Kevin Cousins. So Kevin, to kick us off, PSG Asset Management is really known as a bottom-up house, but how does macro research fit into this process?
So Audrey, the first thing to acknowledge is that macro forecasts are wrong about half the time, especially short-term forecasts. So we don't do macro forecasts. What we do is consider an array of macro scenarios, and we try and think about the likelihood of each one occurring. And then we don't buy stocks based on a macro forecast. But what we do in our portfolio review process is we assess how our funds would do in each of the macro scenarios with the goal of building more resilient portfolios.
So when we think about the US fiscal position, you've been writing and raising concerns about what we've seen developing for some time. So can you remind us, how did we get here?
Yeah, so if you look at America today, it actually reminds us of an emerging market back in the 1980s. They have massive twin deficits, so the current account deficit and the federal budget deficit, and they require funding from foreigners, the kindness of strangers, to keep those deficits going. Now, an emerging market back in the 80s would quickly be shut down by global investors if they did something irresponsible. But the US, as custodian of the world's reserve currency, is given a lot of leeway by markets. So they've been able to run these very substantial deficits for a long time. Now, what that has meant is they built up these massive capital imbalances that wouldn't have been allowed in an emerging market.
So if these imbalances have been building for some time, why do we believe they've become so concerning right now?
Yeah, that's a great question. People have been worried about the US deficit for as long as I've been in financial markets. So why now? Well, I think there are two important points here. The first is that the absolute size of the imbalances has reached levels that are extraordinarily big. So if you look at US net debt to GDP, it's at 100% of GDP. The last time it was there was towards the end of World War II. And then if you look at the current account capital balance, which is called the net international investment position, they have a net liability of $22 trillion. Now, both these amounts have grown very, very rapidly. So that is a key area of concern, that they were edging worse, and now they've just accelerated in terms of how large they've become. So that's the first thing why it's relevant now. And then the second is the impact of the size, absolute size of the imbalance on the current flow. So to explain that a bit, if we look at the budget deficit, the interest paid on the debt balance has risen to be the second biggest item after entitlement spending and bigger than defense spending. And if you look at, and we can forecast quite accurately what interest they will need to pay, and it's going to grow very rapidly from this very high level. And then with the current account, so the current account deficit's $1 trillion a year, and that needs to be funded by foreign capital coming in. The current liquid balance of foreign investment in the US is $35 trillion. So you need that whole $35 trillion to want to stay in the US, and you need another $1 trillion to come in to fund that current account deficit. So picture if foreign investors decide to reduce their US exposure by just 10% of their liquid US exposure. That's a flow of $3.5 trillion. The market impact of that would be huge. And then just the final point to make on both of these, in economics, the thing that people don't anticipate, and it doesn't appear in models, is what we call negative feedback loops, so an example would be that interest burden that we talked about in the budget deficit. As it gets worse, people require a higher interest rate to buy US bonds, so you get a negative loop. Now, with the current account, you could see something similar happening. The foreigners are getting worried about their exposure to the US and they sell, say, 10% of their holding. That sale of $3.5 trillion of US assets, and then a sale of $3.5 trillion US dollars to buy other currencies, would dramatically impact the returns they're achieving on their US assets and potentially get more people to decide to reduce it. So between those feedback loops are something that are extremely dangerous, and you need to factor them into your probabilities.
Surely, US policymakers must be aware of this dilemma, but if so, are they doing anything about it, or are they ignoring the problem?
So I think US politicians are very focused on re-election, and at the moment the median voter doesn't see the budget deficit or the current account deficit as a crucial factor. So in fact, they are not doing anything to make it better. The one big beautiful bill that you mentioned actually makes it worse, the fiscal deficit worse. And then we've seen President Trump launch an attack against the chairman of the Federal Reserve, and also Treasury Secretary Bessent has said that they will fund at the short end of the interest rate curve. Now, these actions been fiscal splurge when you've got massive imbalances, attacking the governor of the central bank and saying you're going to fund short. Those are also things that were common in the 1980s emerging markets.
So Kevin, what do you think should investors be aware of? And has markets taken the implications of these developments into account enough?
Yeah, so on the second point, I don't think so. I think markets in this environment focus quite short term, and they and are not a battle to be preemptive. On the first point, in terms of how to react to this as an investor, I think there are two important lessons that we can take from this. The first is that US Treasuries are a poor safe haven asset. That's been the case since early 2022, and we've talked about it frequently over the past couple of years. And the second is that the US dollar may not knee-jerk strengthen in periods of risk aversion, which is something everyone's relied on. Now, so you need to look outside the US Treasury for your portfolio insurance. That's the first lesson. And then don't be surprised that if the US dollar does what it did in April, where we have risk off and it actually it weakens, it doesn't strengthen. Now that's actually quite good news for emerging market investors. Emerging markets always used to get the double whammy where our asset prices would sell off, but our currency would as well as the dollar strengthen. So the probability that that may not happen in a future risk aversion scenario would be very good news for us, as our central banks wouldn't have to raise interest rates into a weak economic environment.
Kevin, thank you so much for joining me today and looking at the US fiscal position in more detail.
Thank you.